let's like I said, let's dive in. We got two great speakers here, right? John Min, he is a professor at George Mason. He is chief economist as well at Monex. And my favorite part about him is that he's a self-proclaimed nerd like me. So I will eat up everything that he is about to present. And then we have Shannon Dillinger, who is our VP of Trade Compliance. So when Trump sends a tweet or one of you guys asks me a customs question, this is who I go running, kicking, screaming, crying to help me out because God knows you don't want me to answer a question on customs compliance. So last little bit of housekeeping. If you have questions, the chat is open. Please, we want to make this interactive at the end of of the end of the speaking. So please go ahead and submit all your questions in there. We'll get to it. With that being said, John, I'll hand it off to you.
Yes, sir. I got a lot of slides. They're nerdy, so I had to warn everyone in advance. Do you see it?
We can.
Awesome. Okay, so let's jump right into it. I'm a chief nerdy economist with the Monex Group. We've been in business for 38 years. We got 3,000 employees worldwide, and we are very, very good at doing two things. One, taking one currency and converting it to another currency. And second part is actually delivery or the payment side of that. All our international wire cross-border transfers gets settled or shows up in Benny account within 24 hours. And now with the local rails, many of the transactions are the same day. Next one. We just opened office in Singapore, so we can provide 24/7 coverage to our corporate customers. And in the United States, we're licensed in every state except Wyoming, because apparently you can do whatever you want in Wyoming. You don't need licensing. But we do get audited. We do need to put up a performance bond for doing what we do. And we are very proud to say we're in top 5 in terms of currency coverage. We handle 143 different currencies. And lately, we've been getting a lot of strange requests. Like suddenly the Vietnamese dong became very, very popular. So I know you guys are importing a lot from Vietnam, and then that's the reflection of it. Indian rupee became very, very popular after Apple decided to move their iPhone production to India. And of course, Colombia peso, Brazilian real, and so on. So a lot of emerging currencies, and we keep adding them to our list. Just a little fun fact, the world has really changed. So nowadays, we're able to track your international wire real time. We call it Domino's Pizza Delivery Tracker, or the wire tracker. We can let you know exactly where your wire is. And of course, the exchange rate has become very, very important. It looks like all the importers looking for even 100 basis point savings, because I know there's a lot of pressure on your margins due to tariffs. So you're looking for different ways to save. So that's what, and my team is small, consists of 6 other nerdy associates and analysts. We're based out of Washington, D.C. And we do punch above our weight because there are about 96 financial institutions that provide economic and currency forecasts to Bloomberg on a quarterly basis. So if you do have a Bloomberg terminal, you will be able to see our ranking, the real time. And for the past 3 quarters, we were number 7, number 2, and last quarter we were the best. We beat out Citi, JP Morgan, Wells Fargo, Barclays. So our team, much kudos to my team members as well. Now, my team, we gather 3 times a day. We try to, oh, by the way, many of us are inspired by Professor Schiller out of Yale. And his whole thesis is if you want to know where the economy is going, where the market is going, you kind of figure out the story of the day, the story that's driving the marketplace. So every day, first thing, 8 o'clock in the morning, I'm on a call with our traders in London, Amsterdam, Madrid. We're trying to figure out what's happening in Europe. And about 9 o'clock, I'm on the phone again with the traders in New York. We're trying to figure out what's driving the market for that day. And then, of course, we have an afternoon one with our folks in LA. And we try to get the story. And getting the story right is really important because it gives us the conviction. It's like, I call it the North Star. Once you get the bearing straight, then you don't get rattled with those headlines that come or the tweets that come because you stay the course and you provide best information and insight to our clients and our customers as well. So, what am I worried about? There are a lot of things to worry about, and I am still focused on tariffs. By the way, you see that little blue bar, the logo-like thing underneath the Penn Wharton budget model? That's really a cosmic microwave background. The whole idea is 13 billion years ago, there was a big bang and there's an afterglow. I kind of see the tariffs as a big bang, it hit us, and there's an afterglow. So right now, effective tariff rate for the United States after the repeal of IEEPA, we're in Section 301, and I know Sandra is going to go more detail with that. Right now, effective tariff rate in the United States is about 6.5, 6.7%, much less than what I thought it was going to be last year, about 15 to 20%. And in fact, the picture looks really complicated when you look at that. Overall tariff rate is about 6.81%, but obviously the range of variability is wide. Like China overall is about 22%, all the way down to Ireland at up close to 2%. And I just don't know how business folks deal with this tariff schedule based on different commodity industry code, based on exceptions and all that. It's very complicated. From an economist point of view, it was very clear to us when you look at the tariff table, there's an opportunity for robust arbitrage. What I mean by that is if you're exporting goods to the United States from China, you're faced with about 22% tariffs. But if you move that operation to Vietnam, the effective tariff rate drops to 6.4%. And if you want to participate in this mega trend that's happening south of the border, we call it nearshoring, your tariff rate goes down to about 3%. That's actually a photo of El Paso. I was there talking about the USMCA and the implications. And apparently 8,000 trucks across the border every single day. So there's a lot of twisting and restructuring of the supply chain, but it all follows the logic of tariff schedules. I guess that's the takeaway. And in fact, now Mexico, 3 years ago, became the #1 exporter to the United States. It's no longer China. China dropped from #1 to #4. And here's that country that came out of nowhere. Vietnam is #3. That explains the huge surge for Vietnamese dong transactions. But here's an interesting fact. The drop of export from China to the United States really got picked up by Mexico. And if you really look at the share of Chinese export to the United States, either coming directly or through Vietnam and Mexico, their export, overall export, has not dropped at all. That's the graph that you see to the right here. Now, one of the questions from macroeconomist point of view is tariffs. Is that inflationary? We now have a very good set of data that I get from Harvard Business School. They have a pricing lab. Every day they send out these AI bots and they check prices on internet of 350,000 different goods and prices and all that, and they gather them up. And you can see since April of 2025, the yellow line represents imported goods affected by tariffs. And at that time, yes, it was inflationary. The prices of those goods shot up and we had a surge of inflation. But then it looks like a year later, the initial surge of inflation has become transitory. It's diminishing as we speak, and both goods have merged together, domestic and international or imported goods. One thing we do know from Federal Reserve study is that about 94% of tariffs are paid for by someone in the United States. It's not, as Trump administration says, the exporting countries are paying for the tariffs. That's not the case. 94% is paid by the importers or their customers. So inflation seems to be transitory. And what are the overall effects? Oh, by the way, who pays for these tariffs? KPMG did a deep dive first 6 months of this year through their audits, and what they found is about a half of the tariffs are paid for by importers. The other half, their customers or the consumers. That's us. So it's about half and half. About 40 to 50% ultimately pass through the consumers as well. And this is exactly what we saw back in 2019 when the Trump 1.0 administration put tariffs on, in this case, particularly the wine from Europe. The Duke University was able to do a deep dive and look for every cent as to who's paying for the tariffs. And again, it's about 40 to 50% of the cost of tariffs are borne by US consumers ultimately. By the way, if you're a wine drinker like me, I highly recommend these wines from Northern Italy. They're fantastic. So what's the overall effect? I know we're tired of tariffs, but it's still, the glow is still lingering with us. Our best estimate is it jacked up the price by about 0.7% this year. The July CPI, the Consumer Price Index, came out to be about 3.4. So if it wasn't for tariffs, I think we could have about 2.5, 2.6. And if it wasn't for the $4 gas price we're paying, I think we could have been at 2% inflation rate target. But of course, we missed that. What does it mean to the American household on average? It's going to cost each household about $1,100. But within the context of what's happening this year, the average household in the United States will get a tax cut of $2,900 from OBB, the One Big Beautiful Bill. So overall net effect to the US economy has been marginal. So a lot of people were concerned about 15, 16 months ago, tariff will push us into a recession. It didn't turn out that way. I mean, the effect is there, but it's not as substantial as we thought it was going to be. But then, of course, my wife says I always worry about things. I can't help it. I'm an economist. My new worry is inflation. Um, if you look at the graph, this is the consumer price index, the prices the consumers pay. I was very encouraged beginning of this year because it looked like we're headed down to 2%. That's the ultimate goal for the Federal Reserve. And of course, everything changed in February because of the Iran war. And you can see the inflation just shot up. But if you exclude the energy cost, high energy cost, we still have a pickup in inflation that's about 3%. That's still too high. And if you look at PPI, that's the producer price index, intermediate goods, resources, materials, it's running at about 4.7%. So when PPI is higher than CPI, that's telling me that this inflationary pressure is still in the pipeline. And I think we're going to be sticking at about 3% or so. And of course, I was very encouraged when we got a new Fed chair, Walsh. During his confirmation presentation, he says, look, inflation is by choice. It's the choice that we made. And what he said was, for the past 5 years, we made a choice to have inflation that's above the target rate of 2%. The initial surge in inflation we saw back in 2021, that was due to the supply chain. So there was a supply shock inflation. And former chairperson Powell says that was going to be transitory, and it turned out to be transitory. Of course, we kickstart that again because demand side of the inflation picked up. That's because of AI investment, housing cost, the rent equivalent is still very high. We still have the lingering tariff glow, as I say. And then something else, the service wages have really elevated, and the service prices like insurance and things like medical and health, those are really high. So we have about 3% inflation rate. One of my students at George Mason asked me, Professor Min, why do we care whether inflation is 2% or 3%? Well, if inflation stays at 3%, what that means is in 10 years, you lose 25% of your purchasing power in your bank account. Right now, banks are giving you less than 1% on your savings account. So inflation stays at 3%, you're losing 25% of it. So we do need to bring it down. And I said, okay, so Chairman Kevin Walsh says we're going to fix it. I was very encouraged, except when he met, had a first FOMC meeting in DC, he says, I'm not going to tell you how I'm going to fix it. In fact, he says, I'm not going to tell you what I'm going to do. You need to kind of figure out on your own. I'm not going to give you any guidance. And immediately after that presentation, market was pretty much, you can see the bond yield just shot up. That's because, oh no, we have lots of uncertainty. Government is continuing to borrow. Inflation may not come down. You got to give us more return on those bond investments. So the 30-year bond went up to 5.2. Anything above 5, we think is kind of risky for the US economy because cost of mortgage, cost of everything goes up. So we're keeping an eye on that. In fact, the problem got so bad yesterday, US Treasury actually went and bought bonds just to push the yield down. And this morning, I'm looking at the bond yields going back again. And I highly oh no, I would not recommend it anymore. It's kind of scary. If you type in debtclock.com, you get to see the Uncle Sam's, the total outstanding debt. We just crossed the $40 trillion. So all that is showing up in higher yield and the bond price in the bond market. So since Chairman Walsh is not going to tell us where the economy is headed, um, we're going to kind of figure out on my own. So my team did a deep dive, and this is what we found. Overall growth, uh, it looked very volatile. The first quarter of this year, U.S. economy grew about 2%, and that's the potential growth rate. So we thought, okay, that's good. But then last quarter, it fell to 1.5%. So a lot of people are saying, oh, John, is that US economy slowing down with the higher bond yields, high energy prices, and things like that? So we did a deep dive into the numbers. We looked at under the hood, and what we found is something very encouraging. So the blue bar represents consumer spending, which is about 70% of the US economy. The yellow bar is the investment. And we see that yellow bar just get bigger and taller and taller because that's a lot of that had to do with the AI investment. And then, of course, there was two negative bar. One was surge in imports, and another one is drawdown from inventory. So if you look at actual consumption and investment, which is the backbone of any type of growth, we were growing at about 3%. And if you subtract the imports and inventory drawdown, it came down to be 1.5. So it looked solid. And of course, a lot of people said, how could that be, John? Because American consumers are so miserable. So every month, University of Michigan, they survey consumer sentiment. And they've been doing this for a very long time. And we hit the record low last month. In fact, according to this sentiment index, we are more miserable than the time during the COVID shutdown period. And at the same time, the outstanding credit card debt collectively, we're about $2 billion away from record total. Right now, it's about 1.26 trillion. And about 12% of those balances are 90 days behind. And a lot of people said we should be also concerned about the fact that personal savings rate hit almost record low at 2.7%. It looks like the consumers are finally like stretched to the limit, and they're utilizing credit cards and savings to get by. So that's a big warning with this robust consumer spending will continue. And I would say yes,
John, real
yes.
quick, I'm breaking my own rules, but I'm going to interrupt you. Can you talk to
Okay,
my wife about the credit card stuff?
yeah.
Can you,
We are at record uh, total in terms of outstanding credit card bill.
sorry, you probably didn't hear me. Can you talk to my wife about the credit cards?
Well, no, I cannot help you because my wife is still adding to our total.
Good deal.
I show this data to her all the time. She's like, "Oh
I,
my God, it's so boring. It's such nerdy stuff." But
I
here's the
just I've wanted to interrupt a couple times. That time I just couldn't help myself.
yeah, but here's something that really disturbing. A lot of my students are using credit cards, and they don't realize their interest rate is 24% on average. So once you hit the balance, it's really hard to pay off the credit card, and so it's just all that money going to Visa, Mastercard, and the banks. But of course, I'm not that concerned for all the bad reasons, I should say, because we have this tremendous wealth effect that's taking place in the United States. The top 10% of the earners in the United States, they own 90% of the stocks, and they take home 50% of the pay. That top 10% of earners are now responsible for over 50% of all the spending. And if you add the next 10% of the cohort, you're looking at 65, close to 70% of spending is done by that top 20% of earning households. And that explains why the hospitality, international travel, high-end products are doing very, very well. And it's I don't want to say lower 60% of the household. They're going from paycheck to paycheck, and a lot of them have to rely on credit cards. Even the default delinquency rate on auto loans is going up, credit card is going up, and they are feeling miserable. So on a Michigan's type of survey, everyone gets a vote. But then on the marketplace, you vote with the dollars. So on an aggregate level, I am not optimistic. I'm encouraged that there's a lot of spending that's going on, but it's not done by the lower 60%. And at the same time, OBB kicked in this year. So if you're in that top 20% of the household, OBB means you're going to get extra $12,000 to $14,000 to spend this year. That's the tax cut. If you're on the lower 20% of the household, you actually lost about $4,000 to $5,000 because a cut in Medicaid and some of the benefits like a SNAP. So this K economy, as you call it, is going to get worse, but spending is going to be robust because most of the spending is going to be done by that 20 to top 40%. And then, of course, if you own home, congratulations, homes are record prices. And if you own stocks, again, congratulations. Like your 401k balance is going to be super rosy because all the indexes are hitting record levels. By the way, that little picture is me, AI version of me celebrating because when I started working about 25, 30 years ago, I had a number that I wanted to hit. And I hit that last month in my 401k plan. So I was like, yeah. So I'm thinking about retiring now. So we'll see. Now, what does it mean? We truly have a K economy, but I call it intergenerational economy, which is the boomers. I am the last year of the boomer cutoff. And there's baby boomers. They have $77 trillion worth of wealth, and they are fueling the most of the spending in the U.S. economy. So as long as they have money to spend, I think that consumer spending is going to be robust or enough to support the continued growth. And of course, there's icing on the cake, which is the under OBB, there's a very generous depreciation schedule. And in fact, we are seeing a lot of businesses invest because they can depreciate their asset investment all within a year or so. And this is a really interesting fact. I confirmed it twice with a friend of mine who's a CPA. Under OBB, there's a section 179. Idea is that since I do have an advisory business with the tax number, if I invest in a vehicle, and definition of Section 179 is anything that weighs over 6,000 pounds, I believe. Yes. So I guess they're imagining that I would be buying like a F-150 or something like that. But I found out that Mercedes GL SUV weighs slightly above 5,000 pounds. So it would qualify. And if I purchase that, I get to write the whole thing off, depreciate the whole thing off against my taxes this year. And I think there's got to be some rule says I cannot do that, but I'm still looking into it. The implication is in addition to continued consumer spending, we are seeing big surge of investment that's going to be adding about 0.9% to US growth. And of course, AI boom is only accelerating. This year, the AI investment is about 1.2 trillion. Next year, we think it could go up to 2 trillion. But the benefit is somewhat limited because a lot of those AI chips and things like that, they're imported, so they don't go into our GDP. But overall effect is going to be very robust investment in the US. So we are very optimistic for this year. We think we can grow more than 2.3%. This forecast came from IMF just in July. I have a couple buddies that works there, and they say about 2.3, 2.4. We think it could be a little bit higher because of AI investment. And in fact, if you go to Atlanta Fed today, go to their website, you can see how fast U.S. economy is growing real time because they provide their model with the latest data, and they let you know exactly how fast the economy is growing real time. And right now, they think U.S. economy is growing at 4% because companies also ramping up their inventory, getting ready for the second half of the year. So we will see about 3% growth, which is very robust. What that means within the freight industry is that we're going to see another record imports coming into the United States. Despite the tariffs and all that, import volume has only increased and trade deficit has only increased. And when the economy is doing really well and there's AI boom, investment boom, all those materials and all that things has to be imported, including my wine from Northern Italy. So there's been a surge in imports to the United States. And of course, some people might say, John, your story doesn't make sense. Last month, we lost 23,000 jobs in the United States. Yes, we used to generate about 150,000 jobs, but year ago, but then suddenly it just dropped. Now it's like gain, loss, gain, loss, gain, loss. In fact, total number of jobs in the United States is actually has peaked 2 months ago and has been shrinking, which is not really a good sign. Whenever that happens, that's a precursor to a recession. But we think this time is different. And the main reason is since March of 2025, we have net immigration of zero. Previous to that, we were having about 1.52 million immigrants coming into the United States, both documented, undocumented. To absorb them, we had to generate about 100, 150,000 jobs a month. But now we have a net immigration of zero, and population growth is just 0.4%, which is super low. So we don't need to create 100,000 jobs per month. In fact, our analysis shows, along with the Federal Reserve Bank of Dallas, their analysis shows, just looking at the demographics, we just need to generate about 10 to 15,000 jobs a month to keep everyone employed, who wants to work employed. And that explains why the unemployment rate is super low, which is at 4.1%. And I've been looking at this data for the past 20 some odd years. It comes out every Thursday. We got it again, 8:30 this morning. It's the number of Americans filing for the unemployment insurance for the first time, claims. And I really like this data. It's almost real time. Every week, we just gather up the numbers, total collected by different state agencies. And these are actual filing. It's not a sentiment survey type of thing. It's an actual filing of the job claims. And we've been averaging at record low, below 200,000 for the past 5 years or so. Just job market seems to be stable. So here's a snapshot. U.S. Employment market. Compared to last July, looking at the past July, 12 months, we lost about a million jobs in the United States. So labor force is getting smaller. And the people who are not in the labor force increased by 2.5 million. These are the baby boomers who are retiring. So every day, about 11,000 Americans turn 65 right now, every day. And this is going to go on for another year or two. And when they turn 65, a lot of people retire, they leave the labor force. So it looks like we have no hire, no fire, and lots of retired. type of labor force. So given this, it's really hard to grow when you're losing the horsepower. But of course, the good news and big surprise is we have a huge surge in productivity in the United States. I don't know what happened since the COVID shutdown. Uh, we stirred things up after COVID shutdown, and boom, our productivity is growing at 2%, 2.5% versus a pre-COVID average of 1%. We don't think it's AI yet, but there has been a surge in productivity, and it is accelerating as we speak. So compared to the Congressional Budget Office forecast where the productivity is going to be, we're accelerating away from that. In fact, if you see the growth in the United States for the past couple of years, that's the dark blue line. The growth is coming not because number of hours increased. As I said, labor force is just stable, but it's not growing. It's the gain in productivity. So we're getting smarter, not necessarily working harder. And according to the Federal Reserve, all the growth that's going to come from this year is really driven by productivity growth, not just us adding more labor into the labor force. And right now, according to the Bureau of Labor Statistics, the productivity growth rate is about 2.2, 2.3. So we have a baseline growth rate of 2%, not necessarily because we have more workers, but we're getting more out of the existing or even shrinking workforce. What does it mean? Companies are able to continue to pay higher wages compared to the past. The last 3-month average is about 3.6%. It has been cooling a bit, but it's still 3.6%. Compared to the inflation, I've been saying the inflation rate is about 3.4%, but that's how the CPI measures it, same basket of goods. Whenever I walk into my local grocery store, if the price is high, I tend to substitute away to something else. So when you actually look at 15 million real-time observations, again, it's AI bots collecting how we spent money real time. Our inflation that we experience, I should say, is about 2%. What that means is we have a real wage gain of 1%. And when U.S. consumers, when we have any type of gain in our wages, we spend. So every week, I tracked 60 million Americans' use of credit card and debit card. Mostly coming from Bank of America, MasterCard, and Visa. We put it all together. And you can see it looks like our spending has peaked around June 15th of this year. It's still robust, but it peaked. And one of the reasons it seems to me that it has peaked is because there's blue lines, and that's the increase in spending and gas prices. So when gasoline is running at $4 a gallon, it is putting strain on U.S. consumers. And since June 15th, it has been eroding a bit, but still is very positive growth. It's about 3.54% growth in consumer spending. But I put the hourglass in there because if the gas price doesn't come down, and this continues for another 6, 8, 9, 10 months. If I was doing this webinar next year, I may have a story that says American consumers are wiped out, and even the wealthy Americans cannot do enough to support it. So that might be a story that's unfolding as we speak. Oh, I need to speed up a little bit. What does it mean? I'm not going to go do the whole bunch of nerdy stuff, but just to let you know, it looks like the Federal Reserve is not going to raise the interest rate, but it's not going to cut. So I'm betting that they're going to hold. And that's exactly what Chicago Mercantile Exchange, the futures market folks are thinking. September 16th is the next Fed meeting. Any chance of rate increase is only 34%. It was about 60% before. And now people are thinking there might be an interest rate cut in December if the US consumers continue to slow down at the pace that we're seeing as we speak. Right now, still is positive, but we do see it peaked about a month and a half ago. And bond vigilantes, they're telling me the same thing. So far, so good, but I'm keeping a very close eye on it. So what does it mean from a dollar perspective. After all, that's my area of expertise. Right now, if you want to know what my secret recipe is in terms of forecasting where the dollar is going to go, it all comes down to interest rate differential. And as you can see, U.S. interest rate among G7 is one of the highest. Next to Australia, we are the highest. We're at 3.75. Japan is only at 1%. That explains why Japanese yen is so much weaker. We call that carry trade as we speak. You can go to Japan and borrow at 1%, put the money in the US, 3.5, 3.7%. That's the carry trade, and we're seeing record volume of the carry trade. And if you want to explain where the dollar in euro is going to be, you just look at the interest rate differential. And since last July, 12 months ago, it's almost 80, 90% of the exchange rates can be explained just by that factor. As a result, since we're not going to be cutting interest rate, if we're going to raise the interest rate, we thought dollar would get even stronger. But since we're not going to cut it, we do think dollar is going to be very resilient. So let's keep going. Mexican peso, we think, is going to go up to 18, 19. Chinese yuan, we cannot make any type of forecast on that. It's all driven by central bank policy, not economic fundamentals. But with Canadian dollar, we think it's going to go back to 140, which means it's weaker relative to the dollar. And euro, we think it's going to head it down to 110. We are contrarian compared to other forecasters. They think it's going to get more expensive, 120, but we think it's otherwise because there's a good chance Europe may cut interest rate because their economy is not as growing as fast. And the main reason why U.S. economy is going to be especially exceptional compared to everyone else is that whole productivity story is uniquely the U.S. story, as you can see. And of course, AI is kicking in, and AI adoption is accelerating as we speak. In fact, about 50% of the businesses are actively using it. What does it all mean in terms of productivity gains and all that? Moody's, they looked at all the major academic studies that came out in last 12 months in regard to AI and productivity. And I used ChatGPT to summarize all that. And my conclusion is the AI productivity gain is going to be anywhere from 0.3 to 0.9, which means if the US economy can comfortably grow at 2%, with the AI productivity kicking in, I think we can hit 3% as long as consumer spending holds. And that's a big assumption that gasoline price has to get down to 3, or else the story may not unfold the way I think it's going to be next year. So hopefully there will be a resolution with the war in Iran. One interesting fact, all the studies that I have seen, academic studies, says AI is not destroying jobs, it's complementing it, except in the software industry and customer service. So it's not going to be a job killer, as a lot of people are saying, but it is complementary. So, but it's still kind of early to make that a call. One thing that I am concerned about is with all the gain in productivity and everything else, companies are having record profits. And that explains why the second quarter earnings call, on average, US companies' earnings grew about 20%, 25%. But the labor share of the productivity gain is declining. So the more of the gain in productivity is going to the capital versus the labor. So if I was a social scientist, this is not a good thing to talk about. But I'm a macroeconomist. From a macro perspective, we will have a solid growth this year. No recession in sight. We will have record imports. Our Fed is going to be hawkish. They're not going to keep cutting the interest rate unless consumers fall apart at the second half because of higher gas prices, and dollar is going to be resilient. And I think that is my part.
Thanks, John. All very interesting intel that you've shared with us today. Appreciate you joining us today. For next, we're going to dive into the world of tariffs and everything that's going on with customs. I wanted to share a little housekeeping to begin. We're going to share the slides, the recording, and all the reference materials with all of the attendees. So you don't need to worry necessarily about taking screenshots or taking notes. This will all be shared with you after the fact, so you'll have all the resources at your fingertips. In addition,
except for the people that heckled.
Yeah. Also, welcome, encourage your questions. Feel free to enter your questions into the chat. When we get done with the presentation, we'll go through those questions, answer any that we can today. In any that we're not able to answer today in this setting, we will certainly research those and get answers back to you. And just wanted to mention that this presentation, it's general information. This is not legal counsel. We're going to get into some very technical things today. So, of course, when in question, engage your trade attorney. We're going to cover several things today. We're going to do a tariff timeline of where we are today and how we got here. We're going to talk about the IEEPA refunds and a CAPE update and how things are progressing there. We'll talk about the new Section 301 for forced labor and my prediction of what's next. And we'll leave time for questions at the end. So how did we get where we are today? Well, it started with IEEPA, and as we know, the Court of International Trade ruled the IEEPA tariffs illegal and February 23rd of 2026 was the last day that those tariffs were collected. And it didn't take much time for our administration to replace that, and they put in place Section 122 the next day, February 24th. With the Section 122, it was temporary and only good for 150 days, which bought our administration some time. While that expired on July 23rd, the next morning, July 24th, our administration was able to replace that with the new Section 301 forced labor tariffs, which is what we have in place for today. And today that's in place for 60 countries, and we'll dive into that more here in a bit. In terms of the IEEPA refunds, which were, because IEEPA was deemed illegal, it opened up a refund process to importers to be able to obtain that money back. When it was approved by the Court of International Trade, it was approved for all money that was paid. However, a process was only set up for phase one for shipments that had liquidated within the last 80 days. And those shipments were able to be paid in CAPE, which is customs system for applying for those refunds. So far, $128 billion have been accepted for processing in CAPE. And of that, $100 billion paid out so far and back into importers' hands, which is great. That's 60% of the total collections and accrued interest that's been put back into importers' hands to date. These numbers are as of the beginning of August. There's still a gap though, and that's the entries that were beyond that 80 days after liquidation, where the Court of International Trade did rule that these should be refunded. However, that's being challenged. The DOJ has stepped in and has told the Court of International Trade that they don't have the authority to issue refunds for all the importers for things that are finally liquidated. And that in order for an importer to be able to receive a refund on these entries, they must file suit themselves within the Court of International Trade in order to recover their money. So what we're seeing happen today is that the importers that have filed a case with the Court of International Trade, those are starting to get approved, and they're able to file those entries in CAPE and request their refund. We had hoped that that was going to go into place with CAPE yesterday, but it did get delayed. If you're an importer, though, that has not filed suit yet, and you do have shipments that are impacted and in this bucket, our recommendation to you is that you do a financial analysis on the amount of duties that are out there that could potentially be refunded to you, and compare that to what your legal fees would be in order to file within the Court of International Trade for the recovery. If at this point, if you have a large dollar amount that's available to you, our recommendation to you is that you do file case within the Court of International Trade, and that is the best avenue for you to be able to get the money back. That doesn't mean if you don't file a case that you won't get your money back, but at this point that's unknown. As the DOJ and the CIT duke that out, we don't know where that's going to land. You may still get your money back, but it is also possible that the DOJ will require that only those importers that have filed suit will be eligible. So where we're at today, we're currently paying Section 301 with forced labor. This impacts 60 economies, or 99.4% of the US imports. So still almost everything. But there is some differences from the 122 that we were paying previously, is because the 122 was a 10% flat across the board. And today, the new 301 for forced labor is either 10% or 12.5%, depending on the country that you're importing from. What's also different about the new Section 301 forced labor is that there's exemptions available. We didn't see this with 122 the same way that we're seeing it with 301. There are specific product level exemptions that are out there. You can see that we have a QR code posted in this slide for you. If you scan that QR code, it'll take you to the resources necessary to give you the HTS exemption list so that you can look at that list and identify if the classifications you're using on your imports are potentially eligible for exemption. As well as the specific product level exemptions, there's also certain sector exemptions. For example, any aircraft, pharmaceuticals, 232, things of that nature also have exemptions in play. And if you're paying Section 232 on a specific item today, the good news is that the 301 does not stack on top of that. You can use the exemption so that you do not have to pay Section 301 in addition to the Section 232 you're already paying, which is good news for importers that are bringing in specifically metal products. There's also exemptions for specific free trade agreements, such as USMCA or CAFTA, and as well as specific economy exemptions. But again, 99.4% of the goods that are being imported are going to apply. So as an importer, what should you be doing today? My recommendation is that you would first be looking at the country of origins that you're importing from and identify to make sure you're reporting country of origin properly so that the correct duty rate is being applied against your goods. Country of origin rules are complex. Depending on where your suppliers are sourcing their raw materials from and the value of those raw materials, and then whether there's significant transformation done to those products from raw materials, all may impact your country of origin. So this is where I would start. Simply because your manufacturer is located in the country doesn't necessarily mean that that is your country of origin. This is something you should look into and make sure that you're applying the correct country of origin on your entries today. The second area would be your classification. This is a great time, if you haven't already, do a deep dive analysis on the classifications that you're using and make sure that your products are in the correct chapters and that the correct classifications are being utilized. The next would be an exemption path. Once you have identified your country of origin and your classification, review the exemption list to see if your commodity and HTS is listed as one of the possible exemptions that are in play today. And if they are, make sure you're taking advantage of that. And number 4, make sure that you're applying the correct other provisional tariffs that stack on top of the 301. Remembering that not all of them stack. If you're already paying 232, it's very likely that you do not have to pay Section 301 for forced labor. So what do we expect in the future? So we know that forced labor is in play, and we know that the Section 122 just expired. Both of these are already being challenged within the Court of International Trade. Many countries that have forced labor 301 tariffs applied for it are countries that are not known for having forced labor existing in their country today. And those countries are stepping up and challenging this tariff within the Court of International Trade today. And they have a good reason to do so. They're making a really good case for not having to pay for these tariffs. So we'll see where this goes. But as it looks today, they're making a really good argument against it. There's also proposals already of additional 301 tariffs where there's countries where there's trade imbalances. So what they're doing is they're looking at exports from a given country and comparing that to what we import from that country. And if we're importing more than what we're exporting to any given country, then they're doing an analysis on whether or not they could impose a Section 301 tariff for that given country. My personal opinion on this is that this could be Plan B in the event that the forced labor tariffs do get shot down in specific example scenarios where maybe there are countries that don't have a forced labor problem today. The new 301 for countries with trade imbalances, if they could get that across the finish line, could be a replacement for that. So it'll be interesting to see how this all pans out in the Court of International Trade. But it seems that our administration is always ready with whatever's next. The other two notable examples that we've seen are Brazil and Vietnam, and there's digital trade and IP practices. So a lot of movement today. We've provided for you a list of resources we believe will be helpful. All the details for 301, 232, the exemption lists, as well as the original executive orders from the White House on each of these. You can find the links for these in this specific PowerPoint, as well as you can always scan the QR code that's listed here. And if you have any questions, my compliance group email is listed on this slide. Please don't hesitate to reach out. We'll do all we can to support you. So now I'm going to open it up for questions.
Perfect. Thanks, Shannon. I think this one is going to be for you, John. So, Joe, great to see your name here. So, what's the single biggest downside risk you're monitoring for the next 12 to 18 months, and how would your baseline outlook shift under that scenario? And in your opinion, what upside surprises could meaningfully lift your baseline?
Okay, so I am worried about inflation, but I got a new worry, which is $40 trillion debt that we have. Interest on that debt alone is greater now than entire money we're going to spend on defense next 12 months. 20% of all government spending will just go to pay off the interest. Forget about paying the principal. And at the current rate, when the economy is doing well, we have a huge deficit. Just imagine if we have a slowdown and government had to spend more, there'd be less taxes. That could really blow up the long end of the yield curve. So mortgage rate could be 8-9%. Auto loans could be even higher, and that's not a good picture. So I'm worried about that. I'm hopeful that AI productivity will kick in and save us to some extent through growth. Only problem is it looks like income inequality is going to get worse. Unless businesses are willing to share that new wealth, productivity wealth, I think there'll be a lot of social unrest and all that, but that's outside my expertise.
Thanks, John, and going to put you on the spot here. I know you're not a stockbroker, but there's a lot of talk in the AI chip world that they're going to try to go to an asset class. Have you heard that? Do you have any?
Yeah, NVIDIA is bankrolling this with about 4 or 5 private shop. They're going to set aside about $500 billion. Mm-hmm. And the whole compute is almost going to become new oil. I'm already calling it digital oil. And and there'll be markets, futures market and all that for that. And I have to admit, my 401 portfolio doubled in the last 3 years, thanks to AI.
That is great. That is why you get to retire here soon, like you said earlier, right?
Yeah, actually, I was going to retire, but as soon as I realized I could retire, I said, "Oh, it's no longer work."
There you go.
Yeah.
Good deal. Shannon, I think we had a couple come in yesterday for you, right? Let's go with the first one. How do I challenge recent tariff changes as an importer, or what resources are available to assist?
Yeah, it's a great question, Dylan. So when the Section 301 originally comes out, they do a notice in the Federal Register, and they open up that for public comment. And that's really the opportunity that you want to get in at the ground level and to pitch your case of why the fact that tariffs shouldn't apply to your goods specifically or to your industry. So that resulted in the exemptions that we're seeing today for the forced labor. Those are based on comments that were submitted when the forced labor Federal Register notice came out. At this point in time, there's no additional comments or requests for exemption that are being accepted, but that doesn't mean that there won't be in the future. So I would say keep your eyes peeled. At some point, there may become an exemption process. We've seen that happen with Section 301 in the past, specifically for China. So keep an eye on the Federal Register, watch for exemption to come out, and if they do, jump on it. Now, what I would say to that is the new Section 301 that's currently being investigated for trade imbalances, there's going to be a comment period coming out for that. So that would be a good opportunity for you to submit your comments for your specific commodity or countries and pitch your case now to try to potentially have an exemption for that, should that come to fruition and go live in the future.
All right. Let's go down one for you, John. What do your projections mean for the common man? You say the economy is growing mostly due to big money consumers spending on luxury items and experiences, and company profits are increasing. Are profits increasing mostly for giant corporations? How does the spending trend impact companies that sell to normal consumers?
Oh, I'm not going to be popular with my answers here. But I do teach also at a community college, and I interact with a lot of my students. And the 60% of the household I was talking about, they do get by with paycheck to paycheck. Out of the 60%, I believe 40% cannot come out with extra $400 for emergency any given month. So they're at the margin and they're really stretched. And this jump in the gasoline price has really squeezed their spending. And it shows up on Dollar General, even Walmart earnings report today. They says consumer spending is going down and consumers getting pickier, choosier with the money they spend. So the pressure is there, and that's why it shows up as such a negative consumer sentiment on a month after month after month. But when you aggregate that, obviously all that gets hidden. Um, I don't encourage people to do this. One of the fastest growing chain in the United States is a place where people sell the blood, and it's crazy. You get $85 per visit, and it's booming, and it maps the Dollar General store footprint. So that's the amount of pain, I should say stress, strain that's in the economy that's hidden when we talk about those GDP numbers and macro numbers and all that. Um, I think the comment about larger companies earning more profit, the answer is definitely yes. There seems to be more market concentration in industries. In other words, fewer larger companies and industries, and they're enjoying excess profit because they're creating this barrier to entry. So I don't know who's going to challenge Google, Meta, Amazon, Walmart. They're just getting bigger and bigger and more profitable, and they have a pricing power. So if you look at the Russell 2000 companies, they're finally doing well, but it's the big tech, big companies, they're getting excess profit, and they're not sharing that with their workers. That's the disconnect that we're seeing.
Good deal. I may need to get that blood company from you so I can go get $85.
For the credit card bill, I got it.
Shannon, last one that I have. Please submit. Okay, more are coming in, but let's go to this one. Right, I have been told that the new Section 301 tariffs have a 4-year expiration. Is that correct? If so, why did the former Section 301 tariffs never expire?
Yeah, great question. So yes, it is correct. There was a 4-year expiration on the Section 301 tariffs. However, at that point, they review the tariffs and they have the ability to renew them. And that's exactly what happened with the original Chinese Section 301 tariffs. They were reviewed and there was a decision made to renew them. So that's likely what we may continue to see as things move forward.
So this could go on indefinitely.
Yeah, technically it could.
Okay.
All right. Daniel, you are killing me with these numbers. Shannon, with Executive Order 14411 on Form 5106, is there anything companies should be doing compliance-wise other than making sure that that form is up to date and accurate?
Yeah, so what companies should be doing, it's likely that your broker has submitted an electronic version of the 5106 on your behalf, and you may not even be aware of that. You also may not have visibility to the information that the broker submitted on your behalf. So that may or may not be correct. My recommendation to any importer at this point is to connect with your broker, find out what your broker submitted on your behalf, validate that it's correct. And if it's not, it's very easy for your broker to update that information and resubmit it.
All right, team. Well, I think that's the last question I have. Everybody, really appreciate you joining us here today. John, thank you as well for joining us. As always, we've really appreciated you coming on the last few times. And Shannon, thank you for all the insights. So with that being said, we'll let everybody go. We will be sending this out to all attendees and look forward to hosting you next time.